Assalamu alaikum everybody. My name is Samar Hasan and I'm the founder of Epiphany. जैसे कि आप जानते हैं मेरा नाम समर हसन है और मैं Epiphany की फाउंडर हूँ और आज हम नंबर 16th Epiphany Talks के साथ वापस आ गए यानी कि 16वां सेशन है आज हमारा और आज का सेशन इंतहाई इंटरेस्टिंग है और बहुत यूजफुल है तमाम स्टार्टअप फाउंडर्स के लिए जो कि बार बार पूछते हैं कि वैल्यूएशन कैसे करते हैं अपनी कंपनी की और वैल्यूएशन बता दें एंड वैल्यूएशन एकदम से एक सेकंड में तो कोई ऐसी चीज नहीं है कि आपकी पूरी की पूरी कंपनी की वैल्यूएशन हम बता सकें इट टेक्स क्वाइट अ लॉट ऑफ हार्ड वर्क, काफी सारा काम करना पड़ता है। तो वी थॉट सर हमें एक ऐसे एक्सपर्ट को बुलाना चाहिए जो कि वैल्यूएशन ही के एक्सपर्ट हैं। सो टुडे वी एक्चुअली इनवाइटेड Karl, who is an expert of valuation. He's written a book as well called the Fairshare Model, and today we'll be doing a deep dive with him about the Fairshare Model, what it is, why he wrote the book, what valuation is, and what the key drivers of valuation are. So the book came out in 2019, except of course the model behind the book, took some time. He had started cultivating the idea long before that. And what I do want to highlight over here is that please feel free, as always, to share your questions as much as possible. If you're unable to share your questions while we're doing the live session, I'm sure we're going to have Karl back with us pretty soon. All right, so without much ado, I'm going to, add Karl to the stage. Hello, and welcome.
Hello there.
Hi, how are you?
I'm doing quite well, Zoya. Oh, not Zoya, Samar.
No worries, no worries. Zoya's been coordinating with you. So how do you pronounce your last name, Karl?
It's Sjogren. There's an umlaut over the O. It's a Swedish name. In English, there's 26 characters. In Swedish, there's 28. The umlauted O doesn't mean anything in English. So I pronounce it Sjogren, Shurgren.
Sjogren. Okay.
But my kids say Sjogren, so.
Okay, so Sjogren is easy enough to repronounce. So thank you so much for joining us. We're really, really excited. While we were backstage, we were discussing how important valuation is, especially for startups. And some of the startups that we work with, they are not yet at the IPO stage, but inshallah, at some point in time, God willing, they're going to get there. So I think it's going to be a very interesting conversation.
Yeah.
So, I introduced you very, very briefly, obviously did not do justice to the rich career that you've had. So would you be kind enough and introduce yourself for our audience?
Sure. So I live in Oakland, California, in the San Francisco Bay Area, a product of the Midwest. I grew up in the Detroit area, worked in Chicago and St. Louis before coming out to California. I've been out here most of my life. And much of that time I've spent as a consulting CFO controller for startups and turnarounds. And I'm author of a book called, The Fairshare Model. Let me show you one that's not a printer draft, called The Fairshare Model. And it's about a performance-based capital structure for venture stage initial public offerings. I say it's reimagining capitalism at the DNA level because it looks at ownership interests, basically the interest between investors and employees or capital and labor. The former chairman of Silicon Valley Bank called it an important work. It's about 400 pages in the print form. So on Amazon as print and ebook, and it's available on other ebook platforms.
Okay, and why did you write it? What was the reason to write it?
Well, it's basically, like I say here, an effort to reimagine capitalism, to provide a message to spark the idea that there's a very successful model for investing in early stage companies that venture capitalists and private equity firms have. And it helps them make money in the face of high failure risk. And I think that as we've been moving more to an entrepreneurial economy, it would be a good thing if that type of deal structure were adapted to the public markets.
And can you describe for us what the Fairshare model is?
Yeah. Now, first off, it's just an idea. No one has done it yet. Think of it in terms of, we're in the 1700s and we're thinking about alternatives to feudal rule. No one's done it yet, but there's philosophers out there talking about checks and balances and branches of government and accountability. So we're sort of like in that phase with the Fairshare model. Just an idea right now, and it requires people's interest to encourage companies to use it. So with that, it's a structure for how to structure ownership in a venture stage company when it has an IPO. I say a venture stage company is one that is basically a startup, but it could be a more developed company. The hallmark of one is that it doesn't generate enough cash from operation to sustain itself. So it's reliant on fresh capital from investors to exist. That type of company is basically any startup, but it also describes a lot of companies that have gone public over the last several decades. In fact, I'd say just about every biotech company that's gone public would meet that criteria. So the difficult thing is how to value these enterprises. So almost like saying, what's the value of an idea?
Yes. Mm-hmm.
And I used an example in the book to help position this in a reader's mind. Imagine that you're placed in front of a classroom of elementary school children, and you are asked to evaluate, to decide who's going to be a success in life. You can define success however you want. The point is, you're going to be off in both directions. And that's sort of the nature of startups, early venture stage companies. So I boiled down the fundamental risk for investors in two ways. One is failure risk, and the other one is valuation risk. Failure risk, fraud, I say, is simply a combination of both of those combined with false or misleading disclosure. So you boil down the basic risk that any investor in a venture stage company has. Failure risk is, I tell you, I'm going to do all these things and I'm going to jump this high. Those are my operational achievement. And the failure risk is, I'm not going to get there. I'm going to be somewhere between here and the floor. You can mitigate failure risk through due diligence. If you have enough influence, you can also affect it through corporate governance. If it's a private company, you're sort of strapped in for the ride. If you're a public company and you're sensing rising failure risk, you can sell your shares. So that's failure risk. The second one is valuation risk. Valuation risk is the risk of overpaying for a position. And you can overpay for a position in a company that meets all of its marks. So the Fairshare model is an idea to mitigate valuation risk in a company that has high failure risk. Structurally, the way it works is there's two classes of stock. Both of them vote, but only one is tradable. Investors get that. So that's the pre-IPO investors and the IPO investors. And employees get it as well for value generated as of the IPO date. But for future performance, the employees get a voting stock that cannot trade. It converts into the tradable stock based on milestones the company describes in its prospectus, or subsequently both classes of stock agree to. So that's the model.
Okay, hang in there. Sorry. All right. So tell us something else. So you came up with a concept, and you mentioned that it hasn't been implemented yet, and now it's in the form of a book. So have you received queries where people do actually want to apply it, maybe from startups or else from investors? What were you foreseeing when you decided to write the book, and were you hoping that people would actually start using it and there would be experiments, and then you would see the success of this?
Yeah. So there's a chicken and egg aspect to this. It's how do you start a social movement? Going back to that reference I made in the beginning about alternatives to feudal government, nobody's done it. The United States was the first country to attempt an alternative to feudal rule, and we didn't get it right out of the box. We had something called the Articles of Confederation, which was a binding document. And we tried it for about 10 years and it didn't work very well. Then there was a rewrite, which basically emerged with the Constitution. And before that could be approved, it had to be amended about 10 times. And then since then, we've had many types of amendments that were put on, and many more that were attempted. So ultimately, these capital structures are about human behavior, and there's lots of dynamics there. So what was I thinking to start this social movement? The approach I'm using is to use the book to spread awareness of the idea in the hope that it will get people talking and saying, hey, there's an alternative to what we've been doing. What do you think of this? That would lead to the second stage, which is as that critical mass of interest is coalescing, there'll be experts in facets of the capital ecosystem that anticipate companies coming to them for advice on how to implement the Fairshare model. So I'm talking about attorneys, securities attorneys, tax accountants, reporting auditors, corporate governance experts, stock exchanges, regulators, all sort of weighing in to say, well, what would be the best practice to implement the Fairshare model? And the answer to that will vary based on the industry a company's in, the stage of development it's in, and even the personalities involved, frankly. So the book's job is to spark the conversation. And so that's why it's so long, is that I'm anticipating that was a dog. I'm anticipating two audiences. One is the majority. If I were to ask them what a capital structure is, they'd go, I'm not sure. And 30% would be expert. And so the single biggest challenge is to figure out how to write for both. So the book is as long as it is because it gets into so many aspects. It introduces valuation. It asks the basic question about, if you were to draw a curve of that, well, first off, let me explain what a valuation is. Valuation is the presumed cost to buy an entire company based on the price for a portion of it. And the math actually works, is pretty convenient when you're dealing with half ownership. So I'll give you an example. Let's say, Samar, that I start a company and I say, I need some money. And I come to you and I say, I need some money. And you ask, how much do I need? I say, I need one, we'll call it $1. It could be €1, it could be rupee, whatever.
I think nowadays in Pakistan, most of the startups are starting with $1 million, okay?
Okay. So let's say it's $1 million. And then you ask, rightfully, what do you get for that? And I say, I'll give you half the company. We're agreeing, if you invest, that my idea, my future performance is worth $1 million, right? Because your money is worth $1 million. If you add that to my idea, you're going to break even if somebody buys the company for $2 million, right? because you have half the company.
Yep.
So the risk here is twofold. For neither one of us, you don't know and I don't know if my idea is worth $1 million. Could be nothing, could be something in between, could be more, but we just don't know. But in a conventional capital structure, at the time of the equity investment, the purchase of stock, we have to come to an agreement on the value of future performance. This is the equivalent of being in front of a classroom of elementary school kids and trying to figure out who's going to be a success. It's hard to do reliably. So the hallmark of a conventional capital structure is one class of stock. So if you think of this in literary terms, it's sort of like the Three Musketeers, one for all for one. And you're in this case bearing the risk that my idea is actually worth $1 million. Now, if you were a venture capitalist, you would go, I know Karl's idea is worth $1 million. I like Karl. I'm willing to give $1 million, but I don't know. Maybe it's worth 800,000. So you would insist on a modified conventional capital structure. It would be conventional in that you would agree at the time of investment that my idea is worth $1 million, that the shares I have represent $1 million. I had half the company. But you would modify it with deal terms. And the essence of the deal terms would be to give you price protection in case subsequent events revealed that $1 million was too much to pay. Maybe because the company was acquired later for $1.5 million, or another $1 million was required later on, and that person got a better deal than you did, maybe an absolute lower price, or you didn't get the minimum target rate that you're looking for. So in that case, the deal terms would require me to give you more shares for free. Or let's say a company, this company was acquired for $5 million. And you had another deal term, sometimes called a liquidation preference. Liquidation preferences basically say, once there's a liquidity event, that we're not sharing equally. There's an ordering to this. It's almost like how animals decide how to eat a carcass. So if you had a liquidation preference of 1, you would be entitled to receive your $1 million investment back before we split the $5 million proceeds. If your liquidation preference was 2, you would get $2 million of the 5, and then we would split the remaining 3. So you can see how, well, if you think of this from a literary standpoint, the conventional capital structure was one for all for one. A modified conventional capital structure is more like George Orwell's book, Animal Farm, where all animals are equal, but some animals are more equal than others.
Yeah.
But,
okay.
So that's how venture capital funds and private equity funds do so well in a space that has a lot of failure risk. Great idea. So basic idea of the Fairshare model is, let's take that concept and apply it to the public market where anybody can invest.
Okay, so look, one of the questions that came through, right, from one of the founders, and he's, I'm assuming through his question that the business is not, perhaps it hasn't yet started. So his question was that, look, generally startups get their first funding when they are 1 to 3 years old. But how do you get funds when the idea is just on paper or it's in the planning phase?
Well, you offer a better deal. So sometimes early stage investments are structured as an alternative to equity because nobody knows, the investor nor the entrepreneur,
so
how to
early.
value something.
Yeah.
So that's why you see the growth of convertible debt, which is not equity, but the company gets the money and the investor has the rights of a creditor to foreclose on the assets. But usually these are very friendly type of deals where they're just saying, I like you, I like your idea, but we don't know what's going to happen in terms of the value until the next guy comes in.
Absolutely, yeah.
There are other variations of that. There's some so-called safe.
Safe agreement, yeah.
I forget what the acronym stands for. Security or something for agreement, simple agreement for future equity.
Yeah, simple agreement for future equity. Yes, absolutely.
Then there's another one, KISS. Keep it simple, stupid, I guess. But
keep it short and simple, I think. Safe versus KISS, the evolution of the keep it simple security, sorry.
Yeah. So all three of those, well, you can even include revenue sharing type of agreements. All desires to delay coming up with a valuation. So it's sort of an essential thing. If it's going to be equity, you can look at alternatives to it, but ultimately everybody's just kind of groping, how to do it. And this is sort of to answer the question. It's just like life, life finds a way. You do what you have to in order to get to that next stage when you have the underpinnings of something that is bigger. But you want to be thinking early on about how much capital you're going to need over the life of your company, at least in the next several years, until you have the potential to be a non-venture company when you can sustain yourself from your own earnings.
So look, Karl, what's your opinion about bootstrapping? So generally, with very early stage startups, idea stage and early stage startups, we always recommend that bootstrap as much as possible, because that way you're able to secure better deals for yourself, and also you yourself know that there is traction in the market, right? I mean, you know that this model is working, and with the injection of capital, you can actually take it to the next level. I mean, personally, I think that just reduces your stress, right? You are taking somebody else's money. And at the end of the day, you are responsible for someone else's, hard-earned money or whatever, or however it may be, right? So at least, what's your opinion on bootstrapping? Do you think that's highly recommended? Do you think that?
Oh yeah. It's very common. At the same, it's a dilemma though, because sometimes you can starve yourself when to prolong how long you are not taking money, and markets change, the requirements change, or you don't get somebody else comes in and has some financial backing and can do things that you can't. So it's that little time bomb thing. How much time do you really have to do something? So that is a pressure to take on investors, and it's not easy. It's so much stress, but you got to find a way.
So, and then the other piece that we are seeing again and again, a lot of startups nowadays, because of COVID-19, obviously things have drastically changed. A lot of revenue streams that were expected, or there were projects in the pipeline, they've suddenly shut. People had a lot of OPEX as well, which, it's taking time to get rid of everything. So again, for working capital needs, do you think again that they should be looking at raising investment, or should they try and find people who can just extend loans to them, friends, family, and fools sort of category. What do you think should be the go-to strategy for such startups?
Well, you want to have a sober assessment as best you can of how this new environment is going to play out on your prospects. And so you need to be thinking, not only, well, it's inertia is really a great force. You don't have to decide a lot of stuff because the pressure, you're just kind of going with the flow. Now we've had this great interruption in the flow. And there's a host of things that need to be evaluated and no real great model for what's the best way to do it. So, we're all sort of groping through there. And I guess maybe some principles would be to try to really focus on your customer and what their behavior is going to be. If you can show evidence that whatever you're doing provides a good solution to them, these questions are eternal. They always come up. It's just that now we have the wind in our face a bit, and you can't presume something. You can presume, but it's sort of ignoring the wind in your face. And there are some models of businesses that could thrive in this new environment. Others may just be hitting a pause, but it's an indication that the market's going to be rewarding potentially something different than what you had in mind. So and once investors sort of emerge from being in a defensive crouch, I think they'll respond to somebody who very thoughtfully has acknowledged what the effect has been and how their prospects are potentially affected by it and what the strategy is to deal with it.
Okay, so we've got a question. No, so that helps, right? Because I think what you're suggesting is, look, take time, go ahead and strategize right now, see how you need to reorient your business, and then see what you need. Because if you're reorienting your business, you may still need an injection of money. You may still need somebody to help out at this time, but really figure out what your new direction is. Because if you're going to try doing business as usual, which doesn't work in the COVID world, then it's, most probably the answer is going to be no, right? So there's a question which has come in: what valuation models are commonly acceptable to investors during initial phase to value any startup?
The answer is going to vary based on the industry and the geography, but also, frankly, the personalities. Birds of a feather flock together is an old wise saying, and it so aptly describes this and other aspects of human behavior. So you want to be aware of what your comparables are going on, and there are going to be some investors that will go further. This isn't just an exercise in mathematics or marketing. There's a strong emotional component to this. There's the element of an investor falling in love with a market, a technology, a team. And emotion can carry the day in ways that a spreadsheet will not. So the subject of our talk, the drivers of valuation, is really what we're getting to, and that's the second of a series of articles I recently put up. That was the title of it, and I put out a simple concept formula for what is evaluation. One is analytics. The other one's emotion. I just mentioned that. And the other is deal terms. And I talked about that a bit. Let's talk about analytics. So the principal thing that drives analytics is expected income. What is the company going to generate, or what is it going to be worth to somebody down the road, either in an IPO or acquisition? And so the three basic legs of that type of discussion: one is projected income. Another one might be to look at the inherent asset value. Is there something valuable being created, like a molecule to treat COVID-19? And then comparable values, market value. What are other companies in this space worth? The underpinning, I think, the critical one is projected income. But the problem with that is, this is like that analogy to the classroom of elementary kid. There's the saying in computer science: garbage in, garbage out. Nobody is very good at predictably projecting income. And there's another sort of peculiarity about discounted cash flow is, most companies will maybe project out about 4 or 5 years or so once they have products out there. And then there's something they call a terminal value, which is a presumption in the formula that every year after that, that's what the income is going to be. And if you take away that component of the calculation, the value, the present value of that future income stream drops tremendously. Now, I don't know of any companies that can predict perpetual value reliably. I mean, we have been several decades into an era where the half-life of corporations have been dropping dramatically. I saw something that I mentioned in the book where in the 1930s, the average tenure of companies on the Standard & Poor's 500 stock index was 75 years. A few years ago, it was down to about 15 years. So the idea, the premise that, we can, look out into the future and say what's going to happen.
Yeah.
That's why the deal terms are so important, because nobody knows. But this is the thicket that entrepreneurs have to work themselves through in the early stages. Life has got to find a way. I do have an opinion on one form of this early stage financing that I want to share, and that is revenue sharing. The idea will be that an investor will basically be a creditor to the entrepreneur and say, hey, you don't have to give up any equity at all. Give a royalty off of your income. And it can work for a while. It's sort of like a high interest loan, when you're trying to get by. The reason is that I'm sort of negative on them is that undercuts the prospective income of a company. And so if you have in place a revenue sharing agreement that says, okay, 5% or so of your revenue goes to this particular investor. When you need more money from a different source, it's 5% there that's gone. And you just look uglier to the next investor when you're doing that. So if it's a short-term decision to get you over a spot that you can repay or you can replace it with equity, maybe you do it, because you don't want to be melting when you're trying to raise money, and the desperation could lead you to do something. But there's an undertow to that type of agreement. I think the very best type of financing to get is something that is facilitated by your customer or somebody close to your customer, because there's an acknowledgement there that what you're creating has value.
Okay, so look, let me ask you.
A little bit of noise in the background.
Oh, no worries.
Okay.
Okay. All right. Even though, you know, we would love to see your dog, by the way. I think that's one of the best things about COVID, that, you know, I'm like welcoming you into my place and you're welcoming me into yours, right? I can see, you know, your study room, whatever that is. It has brought us closer in a way. Absolutely. So look, I've got a question. Okay, so this is like really a real life example. So one of our startups is trying to expand into another geography. Okay, needs obviously new, you know, more capital to actually expand into the new geography. Now, equity in that business doesn't make a lot of sense. So he is breaking even. He's actually profitable, but very little profit. Okay. Now, one of the investors wanted to offer him a revenue share deal. But of course, if he does a revenue share deal, the additional income which he's supposed to earn, he's supposed to reinvest right now in his business to keep it growing. So it doesn't make sense. Okay. If he goes into a profit share, again, it doesn't, I mean, he's this much profit, right? Again, it's not enough, right? So in the end, right now, at this present moment in time, my only advice to him has been, look, bootstrap for as long as possible. If you need small injection of money, look to your friends, family, and fools. Try and get, you know, somebody to lend you an interest-free loan, because in Pakistan, I mean, we generally do that, you know. Friends will do it and family will do it anyway. So that was my best advice. That right now, just hang on.
I think that's good advice. You know,
but you know, he's very impatient. Right. So after every few days, he pokes me because he's found. So he's very impatient, which is kind of dangerous. But on the other side, he's very persistent, which is awesome. So he's a hustler, right? So every few days, he finds a new investor, potential investor, and he comes back and he says, "Okay, this is the deal. What should I do now?" And I'm like, "Hold, please, just listen to me. Just do what you're doing. Just do that." So I mean, I hope that I'm just going to share this recording with him later. You know, so but. Tell me, because you know sometimes I understand that he wants to grow and he's being very ambitious, and you know I want him to grow. That's the thing. So the bottom line, and however, unfortunately, the money that he needs as a loan is more than I can offer him at this point in time. Otherwise, I would have closed my eyes and given it to him, right? So you know, so tell me what he needs to do, in your opinion, of course, right?
Well,
what he wants to do.
I think probably take your advice. As I'm listening to your story, I'm reminded of the back in the gold rush days in the United States and California. Lots of people came looking for gold, but the people who made the most money weren't the ones who were the prospectors. It was the people selling them supplies.
Yes.
Levi, the banks, the shovel, so. When you think about capital from the investor's perspective, you know, there's not much opportunity to make money by saving it in the bank. The interest rate is so low, and people you know aren't sure what that next thing's going to be. One sort of winning formula could be to latch on to somebody who's got some potential, and you know, give them a little bit of what they want, but get your talons in there a little bit, because they're going to be motivated to repay you, get somebody else to come in, or figure out how to make it work. And there's a reason why deal brokers in this space tend to get a pretty high percentage of a deal. It could be, you know, 15, 18, 20%. Because it's tough money. Equity is the mother's milk for entrepreneurs. It's what's going to nurture them, but it's so difficult to figure out the premise. What is the idea worth? The best thing, I think, is to keep looking for things and work that second element in the valuation driver, emotion. Find somebody who loves what you're doing, loves how you're doing it, and the team you've assembled. Because once you're in love, you start to see possibilities that, you know, don't lend itself to a net present value per se. And it creates this nurturing idea of emotion to help in whatever way is possible. So find a way to make yourself and what you're doing and how you're doing it spark an emotional bond.
You know, that's really, really important what you just said. And this is why one of the things that we really, you know, not just us, but also other incubators, accelerators, will really push people to develop their stories, right? And talk about their stories, because that's where the emotions come from. That's where people will understand. They need to see the passion. They need to see your eyes light up, right? And at times we've also got awful presenters who are just mumbling. And you're just like, dude, if you're not excited about your idea, how is the investor going to be? Or how is your customer going to be? We're just going to think maybe you've produced something really bad and we don't want to, you know, use it or buy it.
And I think, yeah, this emotional plane has resonance in a number of other areas. For example, you as an entrepreneur want to show that you respect the investor and their interest. You're not going to betray them or take advantage of them. So you need to be thinking beyond a transactional relationship. I mean, as if they are friends and family. And naturally, there can be a time that comes up where the entrepreneur's own sense of what they hoped was possible starts to, you know, crumble a little bit. Markets have changed. The execution isn't there. Somebody that they were relying on doesn't show up the way they hope. It may be prudent to recognize when to pack it in and try to settle accounts the way you best can, so that at least you have a friendly reference, if nothing else, maybe a potential resource or next time around. You know, one of the chapters I have in the book is dealing with economic growth, things that are very different from what we've been talking about in terms of transactions. There's a section with 3 chapters that I'm really quite pleased with. One is economic growth, income inequality, and the potential for cooperation to become a new tool for competition. The ability of groups to they succeed because they cooperate better. And there was a Nobel Prize economist that had a lot of impact on me named Edmund Phelps. He's at Columbia. And he wrote a book called Mass Flourishing that I loved. It was so thought-provoking. But one of the things that I kind of distilled out of it was this question of how is it possible that it's good for an economy to be encouraging entrepreneurial activity, because entrepreneurial activity has lots of risk. There's lots of failure. How is that possible? Good. So I'm going to turn the camera to highlight something that just meant a lot to me, and I think means something to our viewers here. So I don't know if it's going to focus. Maybe not. If I take this off here. All right. Can you read that?
Well, okay. A key question emerges if an economy with little or no dynamism can have growth that equals or exceeds one that has it. And if economic dynamism risks disruption, why encourage it?
Edmund Phelps argues persuasively that dynamism is positively correlated with growth. He acknowledged that dynamism can lead to bad luck, but emphasizes that the central reward of a modern economy is that its participants have the opportunity to pursue the Aristotelian concept of the good life. So I use conceptual equations a lot in the book. And I broke down his ideas this way. Modern beliefs and attitudes and values lead to a modern economy. And a modern economy leads to the good life. And there's two components to a good life. The intellectual growth that comes from actively engaging the world, and the moral growth that comes from creating and exploring in the face of great uncertainty. And as I was writing that, I saw the analogy there to what may be familiar to a lot of people, Abraham Maslow's hierarchy of self-needs. We're really talking about self-actualization.
Yes, yeah.
So the point I'm making is part of the entrepreneurial satisfaction doesn't come from success as much as striving.
Yeah, yep. It's the journey, right? Journey before destination.
Yeah, exactly. And so poets and philosophers know this, but sometimes entrepreneurs aren't so sure. There was this peculiarity of I've run into so many entrepreneurs who, even though they didn't have, the monetary success, were happier with their lives because they had strove to do something. And it's that exercise of potential that it makes us a human being and kind of deals with how we can share our dreams and our prospects with others. I think that's, another thing that came out of the book was at one point I was thinking about the 20th century and thought that the epic struggle from an economic standpoint turned out to be whether the commanding heights of the world economies would be controlled by market-based systems or central systems, centralized planning, that animated so much of what happened in the 20th century. And I thought, because around the time I was writing that was about 2015 or so, and I thought, well, what if you had gone to the veritable woman on the street in 1915 or so, 1914, and asked, what do you think the epic struggle of this century is going to be? They would not have come up with that. I mean, the Russian Revolution wasn't until 1917. So I thought, well, the odds are if you ask somebody now what the epic struggle of the 21st century will be, it still has odds are that you're not going to get it right. But I thought, all right, for sure, we could say there's going to be an environmental aspect to this. It could also include catastrophes unleashed by nuclear or biological accidents or events. But those aren't economic. If you're to focus on the economics, I think people would agree that the epic struggle of this century will be whether the benefits of capitalism can be more broadly and fairly realized. So that's sort of the angst that we're all kind of dealing with.
So it's very interesting because we've gone off on a philosophical tangent, right? But I think this is really, really true, and it resonates with me a lot, particularly because when I formed Epiphany a little more than 3 years ago, till today, people question it, right? Because it is a social enterprise. It seeks to catalyze impact entrepreneurship in Pakistan. Impact entrepreneurs don't have a lot of money. So, you could argue that the business model is really stupid. And basically, we have to work double jobs because, we do consulting that earns us money and we channel all of that towards social entrepreneurship. But in terms of satisfaction, in terms of feeling happy, in terms of all of the growth that I've personally experienced, plus the people that I've met around me, and being able to be a part of their journey. I don't think I would have been able to do that where I was working previously or in any other really well-paid job. So I think at the end of the day, it goes back to what works for you and understanding yourself, right? And that's why everybody, different things for different people, right?
Yeah.
Not everybody is going to be an investment banker, but we still need them. We need the venture capitalists out there, right? If we didn't have them, all of the startups wouldn't be able to survive. So I think that's very, you phrased it very nicely, that at the end of the day, there's that. And then in Urdu, there is something else where we say harkat mein barkat hai, which means that, in action, there lies prosperity. So you have to move, you have to do something, you have to take some action. And I think entrepreneurship is all about, just going and taking the plunge. And it may fail, it may be an experiment that you failed at, but that's okay. Are you walking away richer because of all the lessons learned? Or are you, becoming a sad little person because you think you're incapable of anything and everything, right? It totally depends on how you're going to face whether it's failure or whatever, it didn't work out the way you wanted to, right? So, and that kind of, I wanted to, well, anyway, you wanted to say something, go ahead.
Yeah. So you can see it's a big topic. It's so easy to get into so many things. On your social impact point, let me mention on the Fairshare model the performance criteria. First off, there's going to be variation. I say that analogously, the Fairshare model will be to capital structures what the Linux kernel is to computer operating systems. So there's going to be variation again in how this is done, industry, stage of development, personalities. But broadly, I just describe what might be the criteria. One would be a rise in the market cap of the company, the value of the aggregate of the tradable stock. Could be developmental goals like achievement of a project, release of a product, getting through regulatory testing. Third one could be financial, like sales and profits. Fourth one could be the eventual acquisition price, if there is one. When the value of that labor is apparent, what they built with that capital. But it could also include measures of social good. So the challenge is it's a little bit like, you look through a telescope and you can see something distant near up. And that's what we're trying to do with a conventional capital structure. We're looking into the future and trying to say, how does this look now in terms of value? With the Fairshare model, it's almost like flipping that telescope. You're still looking at something, but now you have a different perspective. And the question you have to deal with is, as an entrepreneur, is what behavior do I want to reward and how? And that would be a very different type of discussion with investors. But and companies can adapt. Let's say that they go through. They're going to use a conventional approach to get to the point where they think they can do an IPO. And you can do an IPO early on. You can have an IPO. Yes, you and I could start a company today and have one probably in 2 months or so. We don't even need a product. Biotech companies show that. But what was the point I was going to make here? Talked about the.
You were talking about how when you speak to different investors and you kind of try to understand and have a different conversation, that what are they most interested in, right?
Yeah.
And how they want to reward different aspects.
I think I lost it.
It doesn't matter. Look, it'll come back. But in the meantime, we did have a question, which is very much in line with what you're saying, right? That you could technically have an IPO early on as well. So this is one of the questions. Is there any right time to go for IPO?
It's odd, but classic thinking is that you want to wait until you're business is matured and you're stable and the like. So you can make projections out, because the whole game in the stock market is projections that nobody knows how to do well. But you can have an early IPO. The sooner you do it, the less you have to disclose. I mean, if you're a 1-year-old company, and let's say the regulatory requirement is, say, 3 years of financial, you don't need to be in existence for 3 years to do it. If you've been in existence for a year, you just say what you have. So it's almost like a political candidate. You know, the newer you are to public office, the less you have to worry about potentially. Gosh, I had the thought kind of ran into my mind what I wanted to mention. It's about the conversion. We keep asking the questions and maybe it'll come to me. Okay.
So look, I wanted to actually ask about Fairshare Inc. because we were talking about entrepreneurship and why we do what we do. And then you obviously had this company and you ran it for a few years and then, you ended up closing it. So, tell us a little about that journey.
Okay, good. So the backstory is around 1976 or so, 96. I was CFO of a environmental technology company in the Bay Area. It had pretty cool technology. It was the first licensee of technology from the national lab. And the idea was to use a high energy electron beam to blast streams of volatile organic compounds that were toxic, like could be fumes coming up of a smokestack or petroleum fumes and the like. Blast it with a high amount of energy, break up the molecules into simpler components that are easy to deal with. So you wind up with carbon dioxide, water, salt, potassium, things that were not like petroleum spills. So it was really a cool technology, but we couldn't attract venture capital funds because nobody was making money in environmental plays. It was the early days of the internet. Everybody was going there. So we were reliant on angel investors, and that was a very inefficient way to raise capital. We raised a little bit under $2 million over a couple of years, but it was very spotty as to when the flow would come in, and you couldn't really plan to do things appropriately. So there was another consultant there who I was discussing the inefficiencies with, and we came up with an idea for something we called Fairshare. And the idea was to make it easier and less expensive for companies that had small public offerings to find investors, to avoid brokers and the like. So our approach was to form an online community, give them education on deal structure and valuation, give them the ability to interact with each other. And once we got to critical mass, we would tell companies, if you had a legal offering, if you passed due diligence, if you used our deal structure, the Fairshare model, and you allowed our members to buy as little as $100 worth, we give you free access to pitch your deal. So organizing the buyers to get a better deal. I did not anticipate the amount of time and money that would be required to deal with regulatory concerns. We weren't touching we weren't doing anything at that point. We were just doing education. But our plan was forward-looking into this type of brokerless transaction. And regulators basically looked at us and thought, internet, small investors, small companies, something's wrong here. And we just had to deal with it. But by the time we had dealt with it, we had the .com bubble burst, and then we had the telecom bubble burst. People were not very interested in this idea as we got into 2001, so we closed the company. So I went into a bit of a fetal position for a while. It was my effort, my entrepreneurial effort that failed, but I felt good about. And then we had the Great Recession start to kick in. And in the US, one of the things that emerged as a government response was called the Jobs Act, which popularized something called crowdfunding, which would have been a good name for what we were trying to do back a decade earlier. And I thought, surely somebody's going to come up with the same type of idea we had for Fairshare. I waited a few quarters and I could see all the talk about innovation was about new ways to sell. Nobody was talking about a different way to structure. So I thought, times had changed. The regulatory environment had improved. More interest in entrepreneurship. Gee, you could get a college major in it. There's more awareness of valuation. And I thought, okay, this would have been a good time, and my contribution could be the structural idea, because that's a big idea in itself. Just trying to figure out how to help people figure this out and not focus on the selling side. So that led me to write the book, and I thought it was going to be 200 pages or so, but as I kept thinking, gee, most of my audience is new to this. And there's so many avenues that you can get into, and we just went into a few of them. It's just an interesting discussion. And it rather than talk about the technical details, if you can imprint the philosophical discussion, the framework for people, they'll go on to figure out how to maybe implement it in their environment best. So I wrote the book. Interestingly, the end of '87, I thought I was done. I shared the manuscript with a guy who had just written a book about blockchain. And we met for lunch a month later. He had become a venture capitalist. And he said, I like what you have here, but IPOs are dead. You ought to make them about initial coin offerings. I thought, I'm not going to do that. But I thought, the blockchain would be an interesting thing to look at. So I spent a few months and worked on that. So that's the concluding chapter in the book. Basic chapters, there's 5 sections. One talks about there's about 8 chapters that talk about technical things about IPOs now and valuation. There's the second section of 3 chapters that talk about economic growth, income inequality, and cooperation. 4 chapters on valuation. One is concept, another is how to calculate it. Third one is how to evaluate it, how people will evaluate it. Another one has a proposal that regulators require all company offerings to disclose the pre-money valuation. And the hope is that what would happen if this database is, or the data points are coming into the Securities and Exchange Commission database, that third-party data aggregators would do for valuations what companies like Zillow and Trulia over here have done for real estate. So what they basically do is say, you can look up a property, a house or an apartment, a condo rather, and see what comparable units sell for or have sold for. You could also look at the trend line for that particular property, how it's changed over time. And it makes markets more competitive. And that's one of the premises I've got in the book, is that one of the problems with early stage capitalism from an investor standpoint is this weak market forces. You don't see companies out there competing for investor capital by offering a lower valuation or better deal terms, because public investors, they don't know what this stuff is. But if
Is all about, yeah.
yeah, so if we could get more competition, stronger market forces, it would, I think, open up more capital from the public markets available to entrepreneurs that they could tap into with an early stage IPO. Oh, one thing I wanted to mention, maybe this was the point about how early can you have an IPO. There was a SEC examiner I quote in the book that I talked to, and the question was, hey, how much time you can go public anytime once you get your disclosure documents put away. And he said, you can sell stock in a dead horse. As long as you disclose that it's a dead horse.
Yeah.
So you can say in your IPO, I'm an entrepreneur who only has this amount of the accomplishments I want to achieve, and this is my idea, but I need money. As long as the entrepreneur is meeting the disclosure requirements, they, at least in the U.S., and I'm sure it could be in Pakistan and other regulatory environments, you can have a public offering. You just need to disclose, and you need to offer an attractive deal to your investors. Now, here's the point I wanted to make. I think there's two profound things that are going to come out of adoption of the Fairshare model. One will be that companies will have incentive to offer IPO investors a really, really low pre-money valuation. So and the other one is they'll have an advantage when it comes to recruiting and managing employees. I want to hit each one of them. So let's assume a company has raised $5 million in private capital over a year or two, and now it needs to raise about 20 million more. And it decides rather than go for another private round, it's going to go for a public round. Why would they may want to go for a private round, but in a way it's sort of like inviting a python into bed, because these deal terms can squeeze everybody else if things don't turn out the way they want, they hope. And there could be other advantages to going public and allowing your customers to be investors as well. So, but let's say they want to go raise $20 million and in a public offering, and comparable companies are valued at 100 million. You would expect that the company would go out in its IPO with a pre-money valuation of 100 million, raise the 20, and then immediately after the IPO closes, it would have a $120 million post-money valuation. Secondary market trading would do whatever it's going to do. Contrast that with the approach with the Fairshare model. Let's say same circumstance. It raised 5 million privately. It wants to raise 20 million more. It's going to go public. Management would have incentive to go out with a pre-money valuation of 10 million, not 100. They offer a deal. Why would they? They would still raise the 20 million. And immediately after the IPO closed, it would have a post-money valuation of 30 million. Why would management do this? Because one of the criteria for performance is a rise in the market value of the company based on the tradable stock. The lower you start, the easier it is to get appreciation. So they'd be placing a bet that secondary market investors would say, this company is undervalued, and start to bid the price up. As that happens, the employee stock qualifies to convert into the tradable stock. That's diluting the ownership of the investors, but they don't care because the value of their position is going up. It's well known saying in the venture capital community that a VC would say, I would rather have a small slice of a big pie than a big slice of a small pie. Okay, so that's a big deal. In addition to the emotional factors of what the technology is, what the industry is, what the team is, you now say, hey, it's a deal. Okay? So, second thing is a bigger deal. And that's when it comes to attracting and motivating employees. Let's say, Samar, I'm the CEO of the company that had raised $20 million in a Fairshare Model IPO, and I want to hire you. You have an offer from Apple. I'd say, I can pay you a salary. It won't be as much as Apple. I can give you benefits. It won't be as nice as Apple's. I can give you options on my tradable stock, and they have more upside than Apple's. But I can give you something that Apple cannot. And that's an interest in my performance stock pool. That's that employee stock that votes that doesn't trade. And it only has value if we as a team are delivering these results. So, historically, there's that great naval battle between Sir Francis Drake in England and the Spanish Armada, much more sizable naval force. And with the smaller boats, the nimbleness, the English were able to prevail in that battle. I think the ability to attract the capital because investors are getting a good deal, they're lowering their valuation risk, and the ability to attract and motivate employees in a powerful, fluid way based on whatever the shared criteria of the two classes of stock are, will make for a more nimble company that, once it's proved out by a couple of companies, will become the new normal for how public venture capital is raised.
Well, thank you so much, Karl. I know that we had asked you only for an hour, but thank you so much for doing this deep dive. For the audience, just to recap, I think so basically when we've talked about drivers of valuation, you've talked about three of them in great detail. So you're talking about analytics, which is in a sense, what is the expected income of the company? And obviously, at best, what you can do is do projections. So homework, guys. I mean, bottom line to all the startups, start documenting. What is the trajectory? How many sales are you making? What's the worth of those transactions? How many new customers? How many existing customers who keep coming back? What is your retention level? And so on and so forth. On the other side, what you've got is comparable market. So what is your comparative, your competitors in the market? What are they being valued at? So that's your next kind of, drivers of valuation. And the third driver then is, of course, emotion. So I think we talk a lot about storytelling. We talk about how you need to build that story, the team. At the end of the day, whether you're an early stage, company or whether you're a company which is really mature, at the end of the day, whoever is bringing money on the table wants to know that you can execute and that you've got your skin in the game, right? So, stop thinking that the money that you're going to raise, you want to exit the company tomorrow. Build the company and the exit will follow, right? So I think that's what I would kind of leave as my message. And Karl, a similar message from you to all of the startups out there in Pakistan and whoever else is watching or will watch the recorded version. What message would you like to leave us with?
You're doing hard, all the entrepreneurs out there, and you're doing hard work. Investors that back you are doing hard work. Your customers, your supply chain, it's all involved. This is it's challenging, it's difficult, but it gives us purpose in a way, and it makes life exciting. And I think that's where we find the most meaning. And I just hope everybody has the most success. And I hope they pick up a copy of the Fairshare Model and start to think about different ways about valuation. The big idea is it's possible to innovate in this space in a way that benefits more people.
Absolutely.
And And benefit is not necessarily protecting you from risk. It's mitigating those risks in an intelligent way, encouraging cooperation between the different parties so that there's a shared stake in a good outcome. But if things turn out to be, shaky, you want to be in a position to be able to deal with that as well. It's a great adventure that we're all interested in, and I just hope it's rewarding and richly so, both emotionally and otherwise for everybody.
Thank you so much, Karl. Thank you. It was a pleasure having you.
Nice to be here.
Okay. All right.
Hi.
All right. Okay. So that was Karl with the Fairshare model, and I think there are tons and tons of lessons. So if you haven't been able to watch the whole recording, doesn't matter. I mean, you weren't able to watch the live session, that is. You can always watch the recording later on. Very quickly, so self-marketing, session here. Next Saturday, I'm going to be back for Impacting Lives, actually, with Sidra Iqbal, who's a broadcast journalist and influencer, one of the youth leaders that I look up to. And I'm sure that we're going to have a fascinating conversation. So this is going to be next Saturday on the 25th of July at 9 p.m. Pakistan Standard Time, which means GMT +5. So looking forward to seeing you guys next Saturday. Before that, I'm sure we're going to be back with another session, which at this present moment in time, I don't remember. So thank you very much for listening in, and bye-bye. See you guys soon.